Look at these dividends, dear.
When a major bank raises its dividend payout and your actual annual cash return drops, the market is playing a math trick on you. UOB just raised its interim dividend to 88 cents, but its trailing ordinary yield actually dropped to 3.67%. If you are relying on that payout to fund your retirement, relying on headline announcements alone will leave you short of the risk-free benchmark. Today, we run the honest trailing 12-month math to reveal why a dividend raise left investors with a wider yield gap. I have been following UOB's payout progression closely, and when I ran the trailing 12-month figures against our 4.7% hurdle, the gap widened to 103 basis points. This is one of those quarters where the headline announcement and the wallet reality pull in completely opposite directions. Let's look directly at what the bank reported on the surface. Looking at the surface numbers, UOB reported a very strong second quarter for 2026. Net profit reached 1.5 billion Singapore dollars, representing a 10% increase year-on-year and 3% quarter-on-quarter. Management rewarded shareholders by raising the interim dividend to 88 cents per share, up from 85 cents in the same period last year. On top of that, wealth management fees reached a record high for the quarter. If you only look at these headline announcements, it appears as though the bank is firing on all cylinders. But as retail investors targeting core retirement income, we need to look past the top-line numbers and test whether this distribution genuinely clears our yield standard. The headline dividend alone never tells the complete story. My job is not to celebrate an interim raise in isolation, but to build the actual trailing 12-month income figure that a retiree would collect today. The critical test for any bank stock in our framework is straightforward. Does UOB clear the 4.7% minimum yield hurdle required for a retirement portfolio? That benchmark is anchored against the guaranteed 4.0% return from the Central Provident Fund special account, plus a minimum equity risk premium. When we evaluate income stocks for retirement, a higher interim payment must be proven against the full trailing annual base before we give it a pass. Turning to the full financial release, UOB reported group net profit after tax of 1.5 billion Singapore dollars for the second quarter of 2026, up 3% quarter-on-quarter and 10% year-on-year. For the first half of 2026, total net profit reached 2.9 billion Singapore dollars compared to 2.8 billion Singapore dollars in the first half of 2025. These core operating results show that the underlying banking franchise remains fundamentally sound and continues to generate solid cash flows. However, to understand where those earnings are going, we need to examine two major strategic moves management executed during the period. Management highlighted two major strategic initiatives alongside the operating figures. First, UOB completed a strategic divestment that generated a purchase consideration of 555 million Singapore dollars and a pre-tax gain of approximately 330 million Singapore dollars, adding roughly 14 basis points to the group common equity Tier 1 capital ratio. Second, the bank established a strategic partnership with Allianz Global Investors aimed at strengthening its wealth management franchise and expanding its open architecture investment product offerings. These non-operating transactions reinforce balance sheet strength and support fee growth, but our primary focus remains on the recurring income generated for ordinary shareholders. Examining the core banking metrics reveals a healthy business, but with key operational trends to monitor closely. Net fee income reached 665 million Singapore dollars for the quarter, driven by record wealth management fees even as loan-related capital markets fees softened. However, net interest margin compressed by 8 basis points quarter-on-quarter to 1.74%, placing it near the low end of management's guided full-year range. Meanwhile, the non-performing loan ratio edged up to 1.6% due to a single downgraded real estate account, though non-performing asset coverage remains exceptionally strong at 306% when collateral is included. Now let me show you how we construct the honest trailing yield. UOB declared an interim dividend of 88 cents for the first half of 2026, maintaining its 50% payout ratio. To calculate the trailing 12-month ordinary distribution, we combine this new 88-cent interim with the FY 2025 final dividend of 71 cents. That produces a total trailing ordinary distribution of 1 Singapore dollar and 59 cents per share. Against the current share price of 43 Singapore dollars and 30 cents, that translates to a trailing ordinary dividend yield of exactly 3.67%. Here is the hard gate result. FAL. A trailing ordinary yield of 3.67% sits 103 basis points below our 4.7% minimum yield hurdle. More importantly, it falls below the 4.0% guaranteed rate offered by the Central Provident Fund special account. When an equity investment yields less than the risk-free government benchmark, you are effectively taking on market volatility without receiving any compensation for equity risk. Even though UOB possesses a fortress balance sheet, this yield shortfall represents a structural fail against our strict retirement income criteria. Some investors will point to the special dividends paid in prior quarters and ask if those change the math. UOB distributed two 25-cent special dividend tranches in FY 2024 and FY 2025 as part of its 90th anniversary capital return package. If you include the FY 2025 special tranche, the trailing total distribution rises to $1.84, giving a total yield of 4.25%. However, because that anniversary package is now complete, it represents a one-off distribution rather than an ongoing program. Under our forensic standard, the ordinary-only basis of 3.67% remains the governing figure. Moving to our capital and asset quality screen, UOB's balance sheet metrics pass with ease. Transitional Common Equity Tier 1 capital stood at 15.4% in the second quarter, comfortably above the 14% Zone 4 floor. Fully phased-in Common Equity Tier 1 sits at 15.0%. Net interest margin at 1.74% remains clear of the 1.5% soft flag floor, while the non-performing loan ratio of 1.6% stays below our 2.0% threshold. Total credit costs rose to 24 basis points in the first half from 16 basis points last year, which represents an operational watch item rather than a gate failure. Lungs reviewed a complete financial health checklist for UOB. Trailing ordinary yield sits at 3.67% against the 4.7% benchmark, marking a hard gate failure. Trailing total yield, including the completed special dividend, reaches 4.25%, which also fails the minimum hurdle. Transitional Common Equity Tier 1 capital passes at 15.4%. Net interest margin passes at 1.74%, though it sits near guidance. The non-performing loan ratio passes at 1.6%, while credit costs at 24 basis points are flagged for ongoing monitoring. Overall, capital is strong, but income fails. To understand why we enforce these rules so strictly, consider our core framework. Every stock in our universe is tested against a 3.2% forensic floor, a 4.7% minimum yield hurdle, and strict capital and credit thresholds, all benchmarked against the guaranteed 4.0% Central Provident Fund special account rate. When a bank with a fortress balance sheet misses the yield target, we report it as an income gap rather than a compound structural collapse. However, our forensic standards never bend to accommodate a famous ticker. The hurdle remains fixed regardless of balance sheet strength. Longing at soft flags and zone classification, UOB triggers zero soft flags under current threshold definitions. The compression in net interest margin and the uptick in credit costs are operational trends to monitor, but they do not cross our soft flag gates. However, because the trailing ordinary yield expanded from 71 basis points in the prior quarter to 103 basis points today, UOB crosses the 100 basis point gap threshold. Consequently, UOB's classification updates from Zone 4 to Zone 4 minus, reflecting a wider income shortfall on an otherwise solid balance sheet. This brings us to Iggy's insight on why the trailing yield dropped despite a dividend increase. UOB raised its interim payout from 85 cents to 88 cents, which is a genuine positive step. But because our trailing 12-month window automatically dropped the FY 2024 final dividend of 92 cents and replaced it with the lower FY 2025 final dividend of 71 cents, the overall annual base shrank. A higher interim payment sitting on top of a smaller annual foundation nets out to a lower trailing yield. The next metric that can fix this gap is the FY 2026 final declaration. Tracking the dividend trajectory over recent periods explains the trailing window mechanics clearly. In 2023, UOB paid 85 cents interim and 85 cents final for a $1.70 total. In 2024, it paid 88 cents interim, 92 cents final, and a 25 cents special for $2.05 total. In 2025, the interim was 85 cents, but the final was cut to 71 cents alongside a final 25 cent special. Because UOB maintains a steady 50% ordinary payout ratio, that final dividend cut reflected lower underlying earnings rather than a policy shift. Let me walk you through the honest wallet impact for a retail investor. If you deploy 100,000 Singapore dollars into UOB at today's price, your trailing ordinary income comes to approximately 3,670 Singapore dollars annually. If that same capital remains in the Central Provident Fund special account at a guaranteed 4.0%, it earns 4,000 Singapore dollars with zero capital risk. That leaves a $330 shortfall where holding the bank pays you less than the risk-free alternative. Even adding the completed special dividend produces only a thin $250 premium for taking on full equity risk. One important caveat here, this comparison illustrates the size of the yield gap. It is not a literal switch you can make with unlimited capital. The Central Provident Fund special account is capped by the prevailing retirement sum ceiling. So for most readers, it is not an open destination for fresh money beyond that cap. You do not need complex financial jargon to get a clear edge in the market. Sometimes you just want to know exactly what is happening with your capital in plain English before everyone else finds out. Get everything, 0-day access on both platforms. Full red zone watchlist. Institutional grade cheat sheets with Iggy's elite investors, 12 Singapore dollars a month. Check the link in the description to join our member community today. Comparing the three Singapore banks highlights three very different income stories within the same sector. DBS leads on capital with a 16.6% common equity tier 1 ratio and a 4.23% total trailing yield, placing it in zone 4 plus with a minor 47 basis point miss. OCBC holds a 15.7% capital ratio, but its trailing ordinary yield of 2.9% triggers a zone 5 floor breach. UOB sits in the middle with a 15.4% capital ratio and a 3.67% trailing ordinary yield in zone 4 minus. Long ahead, the single most critical catalyst for UOB is the upcoming FY 2026 final dividend declaration. If management restores the final payout toward the 92-cent level seen in FY 2024, rather than repeating the 71-cent payout from FY 2025, the trailing ordinary yield will recover significantly without requiring any share price decline. Additionally, a potential pullback in the stock price would narrow the yield gap mechanically. Investors should also monitor whether rising credit costs remain confined to a single real estate account or indicate a broader trend across the regional loan portfolio. When evaluating UOB today, the conclusion depends entirely on whether you are holding existing shares or deploying new capital. If you are an existing shareholder who bought at lower entry prices, your personal yield on cost may comfortably clear our 4.7% hurdle, and the bank's fortress balance sheet provides strong downside protection. However, if you are looking to deploy fresh capital at 43 Singapore dollars and 30 cents, the trailing income pays you less than the guaranteed risk-free rate before accounting for equity risk. Same bank, same figures, two completely different decisions based on your entry point. For investors with a longer time horizon before retirement drawdown, a temporary yield gap may be acceptable. If you are accumulating capital and do not rely on immediate portfolio income to cover living expenses, UOB's underlying franchise quality, balance sheet strength, and wealth management growth offers strong long-term value. Capital allocated outside core retirement reserves can be judged under a different investment growth framework. Our Zone 4 minus designation reflects the strict distribution requirements needed for core income replacement funds, not a negative verdict on UOB's broader business strength or long-term operational viability. It is important to recognize that this Zone 4 minus call is a timing situation rather than a permanent verdict on UOB. Our 4.7% hurdle is strictly benchmarked against the 4.0% guaranteed rate of the Central Provident Fund special account to ensure retail investors are properly compensated for market risk. Because UOB's capital position remains strong and core banking operations are profitable, any future upward adjustment in the final dividend distribution or a valuation adjustment will be re-evaluated immediately. When the trailing math improves, the zone rating will adjust accordingly. To summarize today's forensic breakdown on UOB, the stock is assigned to Zone 4 minus. UOB generates a trailing ordinary yield of 3.67% against our 4.7% hurdle, resulting in a 103 basis point shortfall. While capital reserves are exceptionally strong, with a 15.4% common equity tier 1 ratio and credit quality remains sound, the interim dividend raise was offset by prior final dividend cuts. Watch the FY 2026 final dividend release as the primary resolution point for trailing yield recovery. UOB represents a high-quality financial institution with a 15.4% capital ratio and sound asset quality, but its 3.67% trailing ordinary yield currently leaves a 103 basis point gap against our benchmark. Until the FY 2026 final dividend restores the annual payout base, fresh income capital is better protected in guaranteed risk-free alternatives. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle, and to secure your access today. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. The window is already open. The 7-day embargo window is running right now, and Iggy's elite investors receive 0-day access to every complete watchlist update, forensic cheat sheet, and deep dive before public release. Check the link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.